Okay, let's unpack this. You're tuned into The Deep Dive, where we tear apart earnings calls to give you the signal, not just the noise.
And today, we are drilling down into a fascinating one. It's the Q3 2025 earnings call for Blaize Holdings, ticker BZAI.
This call dropped after the U.S. markets closed on November 13th, and it presented a real head-scratcher, a paradox.
It really did. And our mission here is to figure that out, to understand how a company can report absolutely explosive growth, beating expectations pretty handily, and yet
the stock ends the next day lower than where it started. It makes no sense on the surface.
Exactly. The headline numbers were screaming success, but the market was whispering, be careful.
That's the core question we have to answer. So let's start with those headlines. Blaize delivered what Wall Street calls a double beat.
That's right. Revenue came in at $11.9 million. That was above the consensus, which was sitting around $11.5 million.
Okay, a solid beat on the top line.
And on the profitability side, their non-GAAP EPS loss was negative 14 cents per share. That was much, much better than the consensus loss of negative 19 cents. So, beats on both.
And when we talk about growth, the numbers are just, they're astonishing. That $11.9 million in revenue is a 499% sequential increase.
499%.
Yeah.
Quarter over quarter.
You just don't see that. That's the kind of growth you see when a company finally flips the switch from testing to, massive scale.
And that's exactly how management framed it. They see this as their big validation moment for their hybrid AI architecture.
But that's the number that should send a stock soaring, and it just didn't.
It didn't. Despite the beat, despite the very strong guidance, which we'll get to later, the stock traded flat and then drifted down. And this is the key for you, the listener. It tells us the market is completely ignoring that top-line number.
And they're focused on something else, something they see as a major risk.
A funding and execution risk, yes. They're pricing in the problems, not the growth.
So we have to figure out what toxic element was hiding under all that growth. Let's start the deep dive and follow the money. How did they actually earn that $11.9 million?
The revenue surge was tied directly to two massive contracts they're finally scaling up. First, the initial shipments for their huge $120 million Starshine hybrid AI contract.
Okay.
And second, they were continuing deployments for the $56 million Yotta program, which is a smart public safety rollout happening mostly in India.
So this is great news, right? It's proof they can actually convert their pipeline into real deployed infrastructure.
It is, but those deployments came at a crippling cost. And this brings us to the single most important and most negative metric on the entire call.
The gross margin collapse.
It was catastrophic. Gross margin plummeted to just 15% in the third quarter.
Wait, what was it last quarter?
It was 59% in Q2.
Yeah.
A 59% margin. So this isn't just a little compression. This is a total collapse.
Wow. A 15% margin basically means that almost all of that revenue was just them selling low-margin hardware from other companies.
Exactly. It suggests they're not monetizing their own tech yet. They're just an integrator at this stage. Management had to have a very good explanation for this.
I would hope so. What did they say?
They said this was completely expected. They knew it was coming. The initial shipments for these big contracts like Starshine just have a ton of third-party off-the-shelf hardware in them by necessity.
So they're selling the car just to get the customer to sign up for their high-margin subscription service later. Near-term pain for long-term gain.
That's the plan. But that gain is totally dependent on a massive operational pivot.
So what's the path back to those, 50+% margins?
The entire strategy hinges on the second half of 2026. Management says margins will recover significantly then as they transition customers over to servers that are heavy on their own proprietary tech.
Their GSP cards.
Their graph streaming processor cards, yes. They plan to replace most of that third-party hardware with their own GSPs, and that's what will flip the unit economics back in their favor.
But hold on a second. That sounds like it has enormous execution risk. They're counting on a huge, complex hardware swap out across multiple contracts in an 18-month window?
That is the bet. And that skepticism is exactly why the stock is down. They believe that once the customer is running their AI software on the initial hardware, upgrading to the more efficient GSPs will be a no-brainer for them.
A no-brainer because of TCO, total cost of ownership.
Correct. But until that happens, they are burning cash like crazy to fuel that 499% growth.
Okay, let's talk about that burn rate. The GAAP net loss for the quarter was a very heavy negative $26.3 million.
Right. And even the adjusted EBITDA loss was still negative $11.1 million.
Right.
And when you see losses like that against a 15% gross margin, the next question is always about liquidity. Do they have enough cash?
Which is why the financing announcement was so important.
It was just as important as the earnings numbers. Post-quarter, they closed a crucial $30 million private placement.
And what does that $30 million buy them in terms of runway?
Management was very clear on this, that financing plus cash they expect from the contracts pushes their pro forma cash balance to over $60 million.
And how long does that last?
They stated it's enough to fund operations well into the second half of next year.
So it's a huge relief they're not going bankrupt tomorrow, but it also confirms they are completely dependent on outside capital to get through this scaling phase.
It's a high-stakes race. They have to get to higher margins before that $60 million cushion runs out.
Okay, so financially, it's a tightrope walk. Let's look at the story they're telling to justify all this risk, the strategic narrative.
Well, the CEO centered it all around a philosophy they call practical AI.
Practical AI, what does that mean?
It's AI that is business-driven, it's hybrid by design, and most importantly, it's efficient. They're not trying to compete with Amazon or Microsoft in the cloud. They want to be the infrastructure provider for AI at the edge or in sovereign regions.
And that focus seems to be working. They announced some big international deals.
Huge deals. They're making a very aggressive push into sovereign AI markets. We heard about new partnerships with Technology Control Company, or a TCC, in Saudi Arabia.
Which is tied into their Vision 2030 initiative.
Exactly.
Yeah.
And also with Reach Digital in the UAE. So they're targeting these huge government-backed AI initiatives.
And there was a fascinating technical detail that explains why they're winning in those specific regions.
Yes, this is where you can really see their competitive advantage. They talked about how their systems can operate reliably in incredibly harsh, high-temperature outdoor environments.
What were the numbers?
They mentioned testing at temperatures up to 70 degrees Celsius and even pushing it north of 80 degrees on a rooftop in September.
So running reliably at 70 Celsius, that's not just a cool party trick. That directly ties into their pitch about total cost of ownership.
It's central to it. If you can deploy this stuff in the desert without massive, expensive cooling infrastructure, you are saving your client a fortune. A traditional GPU data center just can't do that.
And that $30 million financing, it wasn't just for operations, was it?
No, it was specifically earmarked to accelerate development of their next generation graph streaming processor, the GSP. This is the chip they believe gives them that high margin edge.
And what are they claiming this next-gen GSP can do? This is key to that 2026 margin story.
The claims are big. Management says that by combining their GSPs with conventional GPUs, they can deliver up to 2.4 times higher performance per rack.
Okay.
And roughly 3 times better power efficiency compared to a rack with only GPUs.
3 times better power efficiency. That is a massive differentiator, especially for these energy-constrained sovereign clients. They're not just going to be the fastest. They're trying to be the most efficient.
Precisely. They stress that their customers care less about raw compute metrics like TOPS and more about TCO, programmability, and, just getting the job done at a sustainable cost.
So despite all the financial headwinds, the management team is clearly confident. Let's look at the forward guidance they issued.
It's incredibly aggressive. For Q4 2025, they're guiding revenue between $21.1 and $23.1 million.
So they expect to almost double revenue again in a single quarter.
Yes, that implies another 78 to 94% sequential leap. And looking further out, they're sticking to their goal of at least $130 million in revenue for fiscal year 2026.
130 million, they just reported 11.9. That's almost a 10x jump in a year.
It's a massive step function increase. The message is clear. They are moving from contract-rich, revenue-poor to what we're seeing now, which is deployment-rich, margin-poor.
And the hope is that 2026 is deployment-rich, margin-rich. But the stock is just not buying it. BZAI is down almost 40% in a month and a jaw-dropping 78% over the last year.
The market skepticism is just overwhelming the growth story. It all comes down to 2 big connected risks. First, can they actually execute on the margin recovery? Is this 15% margin truly temporary?
Right. And second, the cash runway. Can they hit those aggressive targets before that $60 million runs out and they have to raise more money, likely diluting shareholders?
Exactly. Management is selling a powerful 2026 scale-up story, But the market is demanding proof, not promises. And that's why the stock is where it is.
Okay, before we wrap up, let's shift gears for our This Is Not Financial Advice segment. We put on our analyst hats and pitch an outrageous but plausible trade idea based on the tension we've just discussed.
This one is ripe for it.
Given BZAI's dilemma, huge growth, terrible margins, and a ticking clock on their cash, I call this one the 2026 margin reversion call.
That perfectly captures it. High risk, high reward. What's the core thesis?
The thesis is simple. The current stock price, around $2.50, is pricing in failure. It assumes they will fail to fix the margins or that they'll run out of cash.
But management just secured the cash and reaffirmed the big 2026 revenue goal.
Exactly. So that deep, deep skepticism is the opportunity for a patient and very risk-tolerant investor.
So what's the action? How do you structure a bet like that?
You take a long position using long-dated, out-of-the-money call options. You want them expiring in late 2026.
Okay, so you're minimizing your upfront cost while giving the thesis time to play out.
Right. And you're betting on two things happening. One, they hit or beat that $130 million revenue number, proving the pipeline is real. And two, they successfully execute the margin recovery in the second half of 26 by swapping in their GSPs.
And if they do that, the stock could re-rate dramatically higher as the unit economics improve.
That's the bet.
The outrageousness here is just the timeline and the perfect execution it requires. You have to believe a company down 78% with 15% margins is going to pull off this massive pivot in a tight 18-month window.
It's a pure execution debt with that $60 million as their finite cushion.
So to recap our deep dive on BZAI, we saw incredible, defining 499% revenue growth and a clear strategy targeting sovereign AI.
But all of that potential was completely overshadowed by that severe margin compression and their reliance on outside money to bridge the gap to profitability.
The market wants proof of margin recovery, not just proof of deployment.
So here's the final provocative thought for you to explore. They have about $160 million in contracted revenue coming just from the Starshine and Yotta deals. How far into 2026 do they need to get, and how high do those margins need to climb before the market finally stops pricing in failure and starts rewarding this genuine, though very risky, growth?
Thank you for joining us for this deep dive. We hope this analysis gives you a better understanding of the tensions at play here. Please remember that all opinions expressed are for informational purposes only. Always consult your own financial advisor before making any investment decisions.